What's poppin', everyone? It's Scout Eveleth, your local realtor, and in today's video we are going to be talking about buying and selling homes completely tax-free here in the Villages, Florida. By the end of this video, you'll understand how to buy and sell real estate completely tax-free, what are the rules and restrictions for doing so, and if this strategy even makes sense for you. So if you're thinking about buying, selling, or just wanting to stay up to date on everything happening here in the Villages, Florida, make sure you smash the like button and subscribe to the channel so you don't miss out. So with that said, thank you so much, and let's get right into it. So today's video focuses on how you can buy and sell real estate completely tax-free using two different methods. The first method will apply to anyone who currently owns a home, and the second method applies only to investment or rental properties. Now, quick disclaimer, the information in this video is for educational purposes only and should not be considered financial or tax advice. I am not a CPA, financial advisor, or tax professional, so always consult with a qualified professional before making any decisions regarding your financial matters. So let's get started with how you can take advantage of tax-free real estate on your personal home. First, you can sell your primary residence and avoid paying capital gains on the first $250,000 of profit if you are single and $500,000 if you are married filed jointly. Now, this exemption only is allowed once every 2 years. Now keep in mind, you can add your cost basis and the cost of any improvements that you make to your home to the $250,000 in profit if you're single, or $500,000 if you're married filed jointly. Now normally you owe a capital gains tax if you sell a home that has gone up in value because it is considered a capital asset. However, thanks to the Taxpayer Relief Act of 1997, most homeowners are exempt from needing to pay this. However, keep in mind, there are some restrictions, so let's go over the details, including the records you should keep while you own a home to help offset any taxes that could be due. So to avoid paying capital gains tax on the sale of your home, it must be considered your primary residence based on the IRS rules and regulations that they set. Simply put, these rules state that you must have lived in the home for at least 2 out of the previous 5 years. So if you've owned your home for at least 2 years and meet the primary residence rules, you could avoid paying all of the long-term capital gains taxes that would normally be owed on the profit. Now, for taxpayers with more than one home, a key point is determining what is your primary residence. The IRS allows the exclusion only on one's primary residence, but there is some leeway for which home will qualify. They commonly refer to this as the 2 in 5 year rule. This rule states that during the previous 5 years, if you have lived in a home for a total of 2 years or 730 days, that home can qualify as your primary residence. This rule even allows you to convert a rental property into a primary residence because the 2-year residency requirement does not need to be fulfilled in consecutive years. It just needs to total that way in cumulative months. So let's say you buy a new home for $300,000. You decide to live in it for 1 year, rent the home for the next 3 years, and when the tenant moves out, you decide to move back in the following year. So after 5 years, you decide to sell the home, which is now worth $450,000. So what this means for you is no capital gain tax will be owed because the profit does not exceed the exclusion amount. Since you sold it for $450,000 and you bought it for $300,000, this is a profit of $150,000, which again does not exceed that exclusion amount. Now, if you buy a home and a dramatic rise in value causes you to sell it a year later, you would be required to pay the full capital gains tax on the profit. This could be short-term or long-term, depending on how long you owned the home. Now, short-term capital gains are taxed as ordinary income with rates as high as 37% for high-income earners. But long-term capital gains are taxed anywhere between 0 and 28% depending on income and tax filing status. So let's talk about the most powerful tool that you can use for buying and selling investment property, which is the 1031 exchange. So a 1031 exchange allows an investor to defer or delay paying capital gains taxes on an investment property when it is sold as long as another like-kind property is purchased with the proceeds from the sale of the first property. So the vast majority of 1031 exchanges are done on what is called a delayed exchange, also known as a three-party exchange. So in this delayed exchange, you'll need to find a middleman known as a qualified intermediary who holds onto the cash from the sale of your property and uses it to buy the replacement property for you. So in order to do a 1031 exchange successfully, it's essential that you follow all of the rules we are about to discuss. Otherwise, you could be on the hook to pay lots of capital gains tax, which nobody wants. So let's get started with rule number 1. The properties must be like kind. Now, to qualify for a 1031 exchange, the property being sold and acquired must be considered like kind. Now, like-kind property is a very broad term, which means that both the original and replacement properties must be of the same character or nature, even if they differ in quality. In other words, you can't exchange farming equipment for an apartment building because they're not even in the same asset class. But in terms of real estate, you can exchange almost any type of property as long as it is not personal property. For example, exchanging an apartment building for a duplex would be allowed. Exchanging a single-family rental property for a commercial office building would also be allowed. And exchanging a rental property or vacation rental for a restaurant space would also be allowed. Now keep in mind, you can exchange a single property for multiple replacement properties, or you could exchange multiple properties for a single larger or more expensive one. But regardless of what you decide, do yourself a favor and get a good qualified intermediary to assist you with this. Now for rule number 2. This can only be for investment or business purposes. Now a 1031 exchange only applies for investment or business property, not personal property. In other words, you cannot swap one primary residence for another. For example, if you moved from California to Florida, you could not exchange your primary residence in California for another primary residence here in Florida. But if you owned a single-family rental in Idaho, you could exchange it for a commercial rental property here in Florida. Now for rule number 3. The property must be greater or equal in value. So to avoid paying taxes on the sale of your property, the IRS requires the market value and equity of the property purchased to be the same or greater than the property being sold. Otherwise, you will not be able to defer 100% of the taxes from the sale. So let's say you have a property that is worth $500,000 and you have a mortgage of $150,000. Well, to receive the full benefit of the 1031 exchange, the new property or properties you purchase need to have a net worth of at least $500,000, and you'll have to carry over at least $150,000 mortgage. This brings us to rule number 4. You must not receive a boot. Per the IRS, a taxpayer must not receive a boot in order for the exchange to be completely tax-free. Now, a boot is taxable to the extent realized on the exchange. In other words, you can carry out a partial 1031 exchange in which the new property is of lesser value, but this will not be 100% tax-free. This difference is called a boot, which is the amount of money that you will have to pay capital gains taxes on. Now, this option is completely okay, and often used when a seller wants to make some cash and is willing to pay some taxes to do so. For example, if your rental property sold for $500,000 and the new property you wish to exchange is worth $300,000, then you would need to pay the capital gains taxes on the $200,000 boot. And now for rule number 5, it needs to be the same taxpayer. So the tax return and name appearing on the title of the property being sold must be the same as the tax return in the title holder that buy the new property. However, one exception to this rule is for single member LLCs, which is considered a pass-through entity to the member. For example, the single member LLC of Sally Jones LLC is owned by Sally Jones. Now, Sally can sell the property owned by the LLC, and because Sally is the only member, she can purchase property in her name and be in compliance with the 1031 code. So these last two are some of the most important. And rule number 6 is the 45-day identification window. So now the property owner has 45 calendar days after closing on the first property to identify up to 3 potential like-kind properties. Now this can be really difficult because the deals still need to make sense from a cash perspective. But an exception to this is known as the 200% rule. So in this situation, you can identify 4 or more properties as long as the value of those combined does not exceed 200% or double the value of the property being sold. And finally, this brings us to rule number 7, which is the 180-day purchase window. Now, it's necessary that the replacement property is completely exchanged no later than 180 days after the sale of the exchanged property. Now, as you might realize, there are quite a few rules and requirements to comply with in order to perform a successful 1031 exchange. To sum things up, the biggest advantage of using this strategy is you can completely avoid paying capital gains tax on the sale of an investment property. And this can be a huge benefit for real estate investors who know which markets are primed to grow, like the Villages. But it can also be a huge downfall for beginner investors or those who don't understand the changing real estate environment. So, if you want to maximize the benefits of your exchange, it's important that you choose your replacement property or properties wisely in a market that has good potential for growth. So to wrap things up, the Villages Florida presents a prime opportunity for real estate investors. Between the steady demand for rental properties, the potential for property appreciation, and the tax advantages of the 1031 exchange, as well as the primary residences, it's no wonder more people are looking to buy and invest here in the Villages. So with that said, I hope you found this video helpful or enjoyable. If you did, be sure to smash the like button and subscribe to the channel so you don't miss out. And if you had any specific questions about buying in the Villages, drop a comment down below. I always make sure to respond to every comment, so I'll make sure your questions or concerns get answered. Thank you all so much for watching. I really do appreciate it, and until next time.